Everybody, and welcome to the Gulf Intelligence Daily Energy Markets webinar. Each morning we take a brief time out from the Middle East morning to reflect on the markets moving and opening in Asia and how they signal for the Middle East and the rest of the Europe and US day. We'll kick off this morning in Asia with Kevin Wright in Singapore, lead analyst for APAC for Kpler. Kevin, good morning. It certainly looks like the markets are taking some positive indicators from the inventory drawdown in the US this week. We had the EIA confirm the API numbers from Tuesday, and we also had an interview with Citigroup this week on Halftime Talk, who also echoed the watch out for quick drawdown of US inventories. Thoughts on that, Kevin?
Sorry, could you repeat the question? We lost you halfway through there, Sean.
Sorry, Kevin. I was just saying on the inventory numbers coming out of the US overnight, very positive.
Absolutely. I mean, 7.2 million barrel draw on crude. We saw a slight build on gasoline, but obviously a draw on distillate as well. So, very positive signals. I think, you've had Matt Stanley on here a number of times over recent weeks, and he always talks about genuine demand. And is demand recovering, or is this really a supply story? And I think I'd be inclined to agree with his general sentiment that it's more about supply than it is about demand. I don't think many Americans would say at the moment that they're feeling particularly bullish about the nation, especially with the spike in coronavirus cases in a couple of states. So I think this is an ongoing story about supply and about rather than about demand.
What about, how does that compare? We had a few moments in the last few weeks where we saw these sort of outlier inventory drawdowns in the US, but obviously the consistent trend line has been the building of inventories. What's the comparison to Asia?
Well, that's a very interesting question. I mean, Chinese inventories are at record levels, over 856 million barrels, I think, according to our data as of this week. And it's building week on week. It's very much the case. Imports have been very strong, even though refinery runs have been high. As we know, I think refinery runs in May were 11% higher than April. So the Chinese have obviously been buying a lot of crude, but also processing a lot of crude. At the same time, it's interesting to note that product exports, especially clean product exports, have actually been a bit depressed, I should say, in April and May. They're starting to recover in June. So it all points to domestic inventories on clean product building, and eventually, you run out of space. It's finite. Once you fill the primary, secondary, tertiary inventories or storage facilities, then you have to re-establish your exports. And I think that's what we're starting to see now. But certainly, inventories on crude have been building in Asia as well.
Shelley Trench, Managing Director at Boston Consulting Group, continuously over the recent months, and the most latest report indicating that OPEC continues to be quite disciplined in their cuts. Is that a bigger factor, do you think, than demand coming in the US?
Yes, definitely. I think OPEC has to be credited for this oil price rally. We need to recognize the 9+ million barrels a day that they've kept offline. And I think that is playing a significant role in what we're seeing at the moment. I mean, OPEC June production in itself is somehow at a 20-year low if we consider the voluntary cuts that KSA, UAE, Kuwait, and other countries are making. So yes, I do think OPEC is playing a significant role in the prices and the rally that we're seeing. And I bring this back, Sean, to a discussion that we had in the Daily Energy Market review about 2 or 3 weeks ago. And the word that I have for the market at the moment is fragile, because when we look at the short-term and the long-term intersection that's happening, that I think it's unprecedented for the market. And let's take a look at the write-downs. And I don't see the write-downs here in your recommended reading, but for me, that's a big indicator. Shell has taken 22 billion off. BP 17 billion, you know, Occidental 9.5.
Yeah, we had those stories earlier, and we had them yesterday as well.
Yeah.
I think.
That for me is huge. And you know, if you look at the Shell share price, going back, you know, past 2005, it's the lowest that we've seen.
That narrative is still playing out.
Exactly. And I think, you know,
down.
closer to home here in the Middle East, we're seeing some of the implications. And, you know, if you look a little bit more closely at what the companies, the large companies here are doing, the regional players are facing big uncertainties, which is leading to project delays, because Aramco with their margin in Berryfield, ADNOC, I think with their Hale and Casher field, I think, yes, OPEC is playing a big role, and we know that because when you look at the fundamentals, and Kevin was talking about the fundamentals, I think they're still quite fragile. And not even to mention what happens in a world where Biden gets re-elected, and then we have to then manage within the context of the transatlantic climate action, the pace of recovery of Iran, and a number of different things that will start to happen.
Rustin Edwards, head of fuel oil procurement at Euronav. How do you interpret the inventory numbers published yesterday? Drawdown, or is it a one-off? Rustin, were you able to hear me?
No, missed about half your question there.
Yeah, yeah, Rustin, I was asking if what your view on.
Yeah, I don't know. Your connection today, Sean, is pretty poor.
Yeah. Hi, everybody. If you can hear me, this is Diala from Gulf Intelligence. Until we get Sean back, can you hear me?
Was regarding it will be a one-off.
Right. So Sean was asking about the inventory drawdown, whether you think that's going to be a one-off or not. I believe we're catching the end of his question. So I will just top tail that. Go ahead, Rustin.
I mean, so in the data, there was an increase in refinery runs. So there's been a steady increase, 1% almost 1% a week now for the last 5 weeks. So refinery runs are coming up. So it is showing that there is some demand. I mean, if you look at the margins in the Mid-Con, they're actually not too bad. Gulf Coast, they're getting better. They're not statically high, but they are trending in an uptrend. And you're seeing the same thing with refinery margins in Singapore and in ARA. So, I mean, that is showing a point that pricing power is starting to work, that inventories are starting to drop, but they're probably not drawing so quickly that refineries need to go from the current 79% level to 90% overnight. I think it's going to be a slow drawdown process. And as long as the refinery systems keep themselves in check and don't overflood the system with goods, I think we'll get a clearing of the overhang of stocks probably here in Q3 and going into Q4 in a much more healthy inventory position than we are right now. But the biggest concern I see, especially in the United States, is the uptick in the COVID-19. You've got governments scaling back some of their reopening plans or enforcing new steps around closing down certain activities, even here in Europe. From here in Switzerland, we're starting to see an uptick in cases approximately 2 weeks after the borders reopened. So it's something that needs to be watched, that if there's any reinstitution of lockdowns, it's going to put everything back into a stock build situation.
Let me just jump in there again. I wanted to actually bring in Matt Stanley for a quick market update of where we're trading this morning. Matt? Matt, if you're there, you can unmute and give us a market update.
Can you hear me?
Yeah.
There you are. I miss the drama. I don't know about anyone else. I mean, who cares about stability? Prices in the 40s. It's all a bit boring. But like Kev said, like Russ said, I mean, a great panel today. With Boston as well on the group. You're talking about someone who's an end user. You're talking about someone who's compiling raw data and someone who's got legitimate, rationale behind what's going on. So it's interesting to hear. But look, the market is being stubborn. I generally don't see quite how we're still up in the low 40s. Demand, yeah, okay, it's ticking back a little bit, but as Russ just said, it's you know, cases are continuing to climb, and the market is just discarding it like a used tissue. It's just, it doesn't make any sense to me. So 42.32 set Brent this morning. TI's in that crucial above $40 a barrel, holding on by its fingernails. 40.09 for August. So yeah, we'll have to wait to see what the week brings.
Kevin, is there on that point?
I'm afraid we're struggling. We might have to
Kevin, in Asia, rates in the West, it seems we're kind of note at the moment. What about in Asia? Okay, Diala, maybe you can take over. I'm going to take off my camera.
Yeah, okay, all right. I didn't catch Sean's question either, but he was referencing Asian demand. We were just referencing the US and the uncertainty about sort of phase 2 of COVID and how that might come back and affect the inventory level trend line that we're seeing today. What about Asia? Any impact there, Kevin? He was addressing the question to you in terms of demand, inventory drawdown. Perhaps you can also reference the recent Chinese law imposed on Hong Kong and whether that's affecting sentiment at all there as well in the demand market.
It's a very interesting question, and it has several answers because it really depends on the countries that you look at. So if you look, for example, at Vietnam, Vietnam had the first case outside China, just as it did with SARS in 2003. So the Vietnamese were very ready to impose a strict lockdown, impose severe restrictions. The military were effectively implementing that on the streets of Hanoi and Ho Chi Minh. And as a result, we saw huge demand destruction, specifically for gasoline and diesel in Vietnam across February, March, and into April. But because of the robust nature of their lockdown, they were able to then ease it quite early, and we saw the demand start to pick up again. So people had their liberty given back to them. We saw personal transportation up, so we saw gasoline demand and gasoline imports start to recover again into May and certainly into June. If you look at the other end of the spectrum, however, Indonesia, which for reasons known only to its own government, decided to almost deny the existence of the pandemic for a while, only imposed the lockdown on the 22nd of April, and even then only in the densely populated areas. As a result, their demand across the period, sort of February, March, April, was relatively robust. But as soon as the lockdown came in, we saw a destruction of gasoline demand and gasoline imports in particular. Now, Vietnam, as I say, is already opening up. Their economy is recovering, and so we're going to see demand recover there. Indonesia, however, which is one of the biggest importers and biggest consumers in this region, is going to struggle as far as probably July and into August. We'll see a resurgence in cases as lockdowns are eased because it wasn't dealt with in that very strict way that it was in Vietnam. And other countries around the region have seen similar stories. So we're starting to see where lockdowns were very robust and very stringently applied, you know, the reaction, the recovery will be relatively fast. And where it's been less robustly applied, where people have sort of had less restriction placed on them, we're going to see a continuation of cases, and therefore we'll see a destruction in demand as we go forward.
Do you think there's any thinking within Asia in terms of what's happening in the US, of the chaos in terms of how the government there has handled it nationally, if you like, in terms of lockdowns or easing of lockdowns, very much by independent states? Does Asia care at all?
That's a difficult question to answer. Does it care at all? I mean, obviously, you know, the whole world looks to the US for its economic direction almost. And so if we see something that is illogical, then I guess it calls into question US policy. I mean, I don't know if it's fair to say that Asia doesn't care or Asia does care. I think it's a simple fact that everybody looks at the US because it's the world's largest economy, and therefore you have to understand what's happening there.
And also, I suppose, in the overall picture about what's going to happen to shale oil in the overall supply picture long term. Shelley, just to go back to you, we have a story on the Digest about the Gulf economies, IMF coming out by saying they're going to shrink by 7.6% this year, an updated report on that. How is that, if at all, going to manifest in their policy or strategy as obviously oil producers and exporters? Are we going to see that kind of statistic impact OPEC's policy going forward after July from a revenue point of view? If you can shed a bit of light on that and how that might impact the whole supply and demand, obviously, story as well.
Yeah. So thanks, Andela, and good to see you again. I think that we will see significant impact. I do think that the economies will shrink. I believe in the forecast. What we will see happening from governments, I believe, is a rationalization of these mega projects that have been planned across the region. So if we look at everything that had been planned within the context of Vision 2030 for Saudi Arabia, the 2030 plan for the UAE, I expect that some of these, let's say, mega city type of developments are going to be rationalized. And at the same time, I expect that governments will be leaning on businesses more heavily. And what I mean by that, and we're seeing some of it coming out already in some of the taxes that are being placed on businesses. We see that in Saudi Arabia starting next year. So I think we see it from that side. And then also, I think the national oil companies themselves are going to have to think of new ways to create the value and to make the contributions that the government had expected of them pre-COVID or pre this economic crisis. And we see that specifically with ADNOC as they move on a monetization strategy. And that monetization strategy, I think most recently was the $10 billion deal that they had to lease their gas pipelines to a 6-company consortium. I mean, I think that's a big step. And I think if we keep looking in the next 2, 3, 6 months, we probably see more of those types of activities happening across the full value chain, which will be very interesting for the Middle East governments and players to start not relinquishing, but opening up their assets a little bit more, their fundamental assets a little bit more to drive significant FDI into the region.
Yeah, and as you said, those strategies to sort of restructure have been in play for a while. I mean, some companies have been, NOCs have been a bit more forthcoming and forthright about taking those actions since 2016. Maybe those are speeding up now. How do you think it might impact, though, in the more immediate sense? You know, Saudi Arabia, the UAE have been taking on the burden of, for example, other OPEC producers who haven't been cutting production, obviously have been, taking on that loss in revenue, if you like, on behalf of others. Do you think that, the emphasis on the economy shrinking and these updated figures will have an impact on their attitude, Saudi and UAE, to taking on that burden going forward after July into the 3rd and 4th quarter, or will they continue to protect the market and keep it in balance?
So that's a difficult one. My inclination is that they will continue to protect the markets, as we've seen KSA, UAE, and some of the others doing over the last month. I think it's in their interest to try to protect and to be a catalyst to drive that positive momentum in the market overall. So I do think that we will continue to see them in the next quarters supporting the market and taking those hits in production to drive prices up, hopefully with a mid to long-term impact overall, though I think it will be very, very difficult for them.
And what about Saudis were due to introduce their 15% VAT this week in July. Is that impacting thinking in any way? Has it come, is it going to be coming into effect? And is it the right time to be doing that, considering what we're seeing in the economy?
Well, I think it's the right time for Saudi Arabia. I think they need it at the moment. And the fact is that we've been living, these companies have been operating in relatively tax-free zones. And Kevin, being in Singapore, which I think is quite a inclusive, supportive economy, you see taxes around those levels. So I think that they are accelerating, which is a natural progression that we would have and should have been seeing over time as they diversify away from a dependency on oil. It's just happening a little bit faster than we expect.
Yeah. Being speeded up along with it with transition moves as well. Rustin, just to go back to you to specifically on oil and just zero in a bit on products. There was an EIA report yesterday on the drawdown in products. We talked a bit about crude inventories earlier on. On the product side, What's your opinion of that? Again, that's a little bit bullish. Would you see that continuing through the third and fourth quarter?
Well, I think it will, as long as refinery runs keep low. I think we'll see these drawdowns continue on. I mean, industrial production is picking up in a lot of different areas. If you look at the PMIs that came out from some of the European Union, in the United States, the PMI was above 50. In China, the PMI was above 50. I think that was on Tuesday when that information came out. So you are seeing more industrial production coming back, which is going to imply more demand from diesel. Airline traffic is starting to tick up. We're starting to see more, anecdotally, more planes in the skies flying across the Swiss Alps here. But I do see more people looking at making business trips or planning business trips here in July and in August, even despite some of the risk of going on a plane and potential of being in quarantine when you land at your destination. So, I mean, there is demand that is starting to come back into the system. I think demand continues to come back as long as there's no major increase in COVID or any government takes the dramatic steps to reimpose lock-ins and reimpose shut borders. So as long as things keep moving in the right direction, I think we will see demand pick up. I think we will see stocks draw, and I think it's going to take Q3 to make that happen.
Just zeroing in a bit on the marine industry and low sulfur, high sulfur fuel oil. Obviously, this year we've seen a big transition with the IMO directives coming in and the differentials there surprising people to an extent in the last quarter or two, and how that's moved. What would you say about what's your outlook for that, for the tightening between LSFO and HSFO, and where do you see that going?
Well,
during
I think the tightening continues. With Venezuela basically being offline, OPEC oil cuts are mainly focusing on the heavy sour barrels. Russia is complying with their exports as well, and also they have their own issues on exporting out to more volume than they really can. Than they really think they can. So, I think the tightness is going to continue to happen. From the demand side, you've got the new RDS capacity that starts to come online in China as they start ramping up their 0.5 production. And that RDS production is going to increase demand for another 300 to 400,000 tons a month into China as feedstock, just to keep those units in capacity, and also for China to meet their export quota of about 18 million tons a year this year for 0.5 fuel. So that feedstock has to flow into there. You also have the refining system in India and in the United States, which has been doing a very good job at clearing high sulfur fuel oil from the marketplace through cokers. So that tightness is going to continue. From the flip side, from 0.5, I think the supply for 0.5 is fairly robust. And as a way to clear out a lot of distillate overhang in the market, the marine fuel market is the way to go, because that's the one piece that still has been kind of consistently in a demand phase, even throughout the COVID lock-ins. I mean, with COVID lock-ins,
and also from a preparatory point of view, you had a lot of the supply of the refineries there preparing. It was much better prepared as a market than people were expecting for the new year, and there was quite a bit of supply overhang at the beginning of the year. I'd like us just to go to a survey question today. Irene, if we can please bring that up for our viewers and for our panelists. And this is talking about the US, re-election of Trump. What's the likelihood of that? You have three options there. If we can ask everybody to vote on that, and we'll have a look at the results in a few minutes when we get those back. So what's the likelihood of Trump winning the election? Likely, doubt it, no chance. So if everyone can have a go at voting on that, we'll see how that comes back in a few minutes. I'd like to go to you, back to you, Sherry, on that question. So, I mean, what other factors would you say would be playing out in Q3, apart from the preamble to the US election? What other big factors are we looking out for which are going to impact the markets on your radar?
Well, the definite elephant is COVID, because I think we are on the cusp of what could be a second wave, which will have dramatic impact on demand overall. And we're seeing the second wave happening in the US, India, Brazil. So I think this is a big one for us to monitor, how governments are going to balance between being cautious, keeping lockdowns in place, and re-energizing or reinstigating the economy. So I think this is number one, is going to be the COVID outplay. Q3, Q4, obviously, as we mentioned before, and as we're doing the poll on, is going to be the outcomes of the US elections, because I think the future of oil and gas and future of energy is going to be significantly impacted by the role that Biden is playing as we look at how he pushes aggressively for greener energy, managing the relationships with Iran and their ability to produce oil, and then the relationship with China overall. So I think that in itself is going to be, the second one. And I think the third for me is looking at how the oil and gas companies themselves and bringing it back to the sector are going to continue responding, and how these supposed strategies that we're seeing to diversify and to move
We're
away.
losing Shelley a little bit there. Kevin, have we got you? Oh, we seem to have frozen. Everybody seems to have frozen for a second. Let's see if we get everyone back.
I still hear you.
Yeah, I can see everyone clearly.
Can anyone?
Just to wrap up, I think Q3, Q4 will be quite important for that. I think a lot of
Yeah, we lost you a bit there, Shelley. I'm not.
Okay, so maybe we move on. Diala.
Well, maybe we've lost Diala.
I think we've lost Diala because I've had good connection.
I got to jump back in here. Kevin, can you hear me?
I can indeed, loud and clear.
Yeah.
We're all back.
Okay, Kevin, I was just going to say from the point of view of the election, obviously big factor in Q3, second half of the year. The general narrative is that the Trump is better for the energy industry, Biden less so, at least for the oil and gas industry. Is there a perspective in Asia emerging as a preference there, particularly out of China, and what it would mean, the difference?
Wow. I mean, clearly that relationship between Xi and Trump has become considerably strained over recent months. Is there a preference for Biden? I really can't comment. I don't have any sort of hard facts or evidence to give you on that, so I'm afraid it's a bit difficult for me to answer.
Right. In terms of your own outlook, what do you think are some big factors to keep an eye on for Q3 that could be a carryover from Q2, inventories, China-US face-off? What do you think are the big factors in Q3 to keep an eye on?
Well, I mean, Shelley raised the point, and you can't overemphasize how important the recovery is going to be. If we get a second wave of this disease, then everything else is going to seem relatively minor, I think. Because the reaction.
When you take that point, it does seem to be a divergence there, as we commented earlier, that COVID, at least for now, is at least in the West, is kind of being parked to the sideline. Major issue, but you're saying recovery cannot happen with COVID. There has to be a after COVID. I mean, I think there's a with thing growing.
Yeah, can I
Please, Shelley, go ahead.
Just a quick one, Sean. I think it is not being put to the sideline. I don't think it will be able to. If we look at ICU units across the US yesterday and today, they're getting to 97, 98%. I think Houston is at 97% capacity. So I think we will see in the next 2 or 3 weeks where the capacity to deal with COVID in hospitals is going to exceed the demand for beds, and this is when we will see a subsequent reaction again. Sorry, Kevin, go ahead. But I think it's a fast to think that they will be able to continue to avoid dealing with COVID.
I think that's absolutely right. I mean, you can't park something that has such a huge impact on such large populations. Personal mobility, industrial activity are all massively impacted by restrictions, and therefore to ignore COVID, to park COVID, to ignore it within price action, I don't think.
Well, it's not an ignore, but we're clearly seeing the market coexist with, right? The market went from -40 to +40. It's going close. It wants to get to 45. Inventories are being drawn down. These are all with COVID realities, and I don't see anything that just derails that.
Yeah, I mean, you've got to take a hard look at that -37 or whatever it was print back on WTI in May, because that was a result of a set of circumstances that were very unique. You had limited demand, you had inventory situation in Cushing, you had obviously the the delivery mechanism of the contract itself. All of these things played into that. Now, we've started to see a recovery on the back of OPEC cuts, which have been swinging. I mean, 9.7 million barrels taken off the market. That has to have a positive impact in the end. It has to be supportive. But is that a long-term tenable situation? I mean, you know, are the OPEC countries able to maintain that level of reduction in their revenues effectively, and therefore the impact on their GDP long-term? Because if that's what we're talking about, living with COVID means, then I think that's I think certain countries in the Middle East would struggle to maintain that for a long time.
Rustin, your closing thoughts. Before Rustin gives us his closing comments, let's bring up this poll result and see if Mr. Trump will be reelected. No chance is not getting too much love. Likely and doubted are fighting it out. So likely and doubted, Rustin, I won't ask you where you were on it, but ultimately, what do you think are the big factors to watch out for in the coming quarter that we've just kicked off?
Actually, the one thing that kind of concerns me is Libya. There's a lot of saber rattling going on around Haftar and the LNA versus the GNA versus the LNA from the UN recognized government. You've got Turkey and Egypt squaring off in a diplomatic row around it. Egypt putting a red line that if the government attacks Sirte or the Rafah airfield, they're going to come in and support the Haftar forces. So that, to me, is a fairly large red flag that doesn't seem to be getting a lot of press at the current time. And that kind of concerns me, that could be...
A country in its pomp was producing over 2 million barrels of high quality sweet crude oil.
Yes, it was, and now it's barely making 300,000. But just the fact that you've got a lot of international players involved in that space right now. You have France, Russia, Turkey, Egypt, and then the two warring factions in Libya, UAE, all with their proxies in the country. That's something that I think that I've been watching closely for the last couple of weeks. I'm going to continue to watch because that could divulge into something far worse than what it currently is.
We've found in the past, Rustin, that when geopolitical issues flare up, we saw the India-China thing recently, obviously the Libya thing you point out, which is got a Turkey-Egypt face-off about it. But in the past, when geopolitical flare-ups have happened, when inventories have been at a very heightened level, the market has kind of dismissed it as not being as big a concern because of the inventory levels. Do you see that correlation, or what's the outlook for that, the inventory drawdown? Does that become a consistent trend in the third quarter?
Well, again, I think drawdowns are going to be a consistent trend in the third quarter. I think it's going to be led by the products, and then crude is going to follow. One of the pieces of note in the third quarter is that today the UMCA comes into effect in the United States, which basically it's NAFTA 2.0. And so that could create a interesting counterpoint to OPEC, in that there is a lot of buy North America provisions for energy inside that treaty agreement. So we could see some interesting reshuffling of the deck chairs, if you want to say, of where Canada, Mexico, and the United States.
Okay. I think we're going to wrap it up there. Our 30 minutes are up, and the gremlins are certainly having their day with our Zoom signals, but zooming it for 4 months, and this is the
Zoom is running out of steam. Zoom is running out of steam, I think, globally. We've started the third quarter. It's on strike.
Well, it's certainly a phenomenal new toy that we'll continue to play with. Rustin and Shelley and Kevin, Rustin in Geneva, Shelley in the region, I think, although our backdrop is looking nicely. Oh, there it is. Thank you. Okay. And Kevin in Singapore. Have a safe weekend. If it is the end of your week, it is here in the Middle East, and have an economically productive one. And we'll see where this Q3 goes. Recommend the halftime talk interview with Ed Morse of Citigroup for if you want an optimistic outlook for the second half of the year. He certainly gives one. He sees the rig count in the US recovering from 200 to 600 within the next 12 months, and a very, as he said, rapid tightening in the supply-demand balance of the third quarter. So That's his view. He's not the worst at that game of forecasting, but worth a listen for a half-an-hour interview. All the best, and thank you for your patience today, and have a good day. Thank you.